Thursday, February 15th, 2018, Monaco 64, home of alternative economics and contrarian views. It's around 8:30 a.m. and before I go look at the markets and a lot of charts today, I want to look at the charts, see where we are in the bigger picture. I want to talk a little bit about what happened yesterday in the markets. We had some CPI data from the US and they came in higher than expected. So core CPI, which excludes food and energy, came out at 0.3, 1.8. That's month on month, year on year. It was expected 0.2, 1.7. The previous number, though, was 0.2, 1.8. So there wasn't much change there. The headline CPI, which includes everything, came out at 0.52.1. It was expected 0.3, 1.9, but the previous number as well was 0.2, 2.1. I think, there's a lot of talk about, higher than expected inflation, led to the bond market falling and yields rising. I think this is baloney, personally, because, for example, in the UK, the CPI and the RPI, which is another measure, is running around 3% and 4% respectively, and the yield on the gilt, 10-year gilt, is less than 2%. So I think we need to just look at the markets and see what they're doing and forget about the noise in the short term. Gold as well yesterday was trading already quite well before the numbers. We'd gotten up above 1330 overnight. And then the numbers came out and the reasoning for traders and high frequency traders, algorithms, was that if CPI or inflation was higher, that meant the Fed was going to hike, so gold was going to get slammed. If CPI was in line or lower than expected, that meant that there was no inflation, so gold was going to go down. And gold did go down. We touched the 50-day moving average. We went down to around 1317, and it rebounded really well after that. And it went on to make new highs and had a very good day, the best day gold has had for a very long time. I think we were up, more than 20 bucks, almost 2%. Silver as well did very well. So what I'm trying to say here, yes, I think they've made a big deal about this number, this CPI number, because they didn't actually rise. If you look at the previous number, they were just a little higher than expectations. But the real bad numbers, I think, that people didn't focus on was real earnings. Real earnings were down 0.8. They were expected down 0.3, and they had come out 0.2 the month before. Retail sales as well were low, down 0.3 month on month. They're expected up 0.2. So I think we are seeing, I've made videos about stagflation, and we already have stagflation for the general public, the people who are not the 1% or, just a bit further down that earning a lot of money from financial services and real estate. For the general public, for the middle class, for the lower classes, people already have had complete stagflation. Their wages are stagnant. Cost of living is going up. The tuition, housing, health, food, everything's going up. So this is not surprising. What this shows, though, is that maybe the government is having a tough time hide it, even in their data. Let's look at some of the charts. Start with gold. We looked at this earlier, and you can see I was talking about this downward trend channel there that we've had. This is a daily chart, short-term chart. We were able to break out of it yesterday. We even fell back, after that CPI data, but it rebounded really well. This morning, gold's continuing to do well. It's made a slightly higher high here. But the key level, of course, now is going to be the high from January 25th, which is around 1366. Of course, the I think July 2016 high was 1375. We could be off to the races if we break through that level before the end of the week or before tomorrow. Let's have a look at the longer term chart of gold, the weekly chart, see how important these levels are in the context of the longer term. So this trend line here has been that's where the roof of this consolidation we've had since 2013 is, and that line is right around 1365 this week, but I think the break of the July 2016 high at 1375 would really confirm a break above that trend line, and then we could be off to the races in gold. We could be talking 1600 or even more, but we have to get through that line though. So what about the dollar? The dollar's continuing to weaken quite a bit. As I speak here this morning, the pound is up 1/3% at 140.46. The euro is up 1/3% at 124.90. And the dollar is down another 0.5% against the yen at 106.47. So that the dollar yen is breaking down even more. So let's have a look at the dollar index. So here's the chart. It's a daily chart. 50-day moving average is the black. The orange is the 100, and the green is the 200-day. So they're all moving, the way they should in a bear market. The low so far this morning has been, let's see, 88.58. So we're very near the 88.43 low from the 26th of January. So yeah, if we break that level, we could see an acceleration in the dollar down. Will it hold? I don't know. We just need to see, but it doesn't look good. The momentum looks down for the dollar. Bond prices are also continuing to trade lower. The bond yield made a high so far overnight this morning in London at 294. Right now we're at 293, and I've talked about how the 3% level is very important. You can see that was the high in the end of 2013, beginning of 2014. On a closing basis, that 3% level is very important. You can see that earlier this year we broke through that 263 yield level, which is a double top from the end of 2016, beginning of 2017. Will yields, they've gone up already quite a lot from the low in July in the summer, around 135. They've more than doubled. Is this the end of the upward cycle in yields, which would be, maybe a little more positive for the dollar? I don't know. It's going to be really important to keep an eye on the yield the next few days, next few weeks. If it breaks through 3% and doesn't come back down, we could be in for a rough time in the financial markets, because the price of bonds and the yields on the bonds determine interest rates and the cost of money. And if that's going up, our credit economy will be in trouble. Let's have a look now at the stock market, at the Dow. As you can see here in this daily chart, the Dow has rebounded quite well from the low in the 9th of February. The low was 23,360, just above the 200-day moving average. We're almost back towards the 50-day moving average, which is at 25,130. This morning, the Dow is up another 175 points at 2575. So we're getting very close to that line. Personally, I think we could continue to go higher for a little longer, and for the next few days or even week, and then we're going to turn around to retest the low. So I don't think the stock market is out of the woods yet. Cryptocurrencies, they've done very well the last couple of days. This morning, Bitcoin is at 98.60. LITECOIN has been leading the way. It's at 231. Ethereum 944. So we're right near the highs here. EOS is just trading around 10 bucks. Chart of Bitcoin. The first chart I'll look at is the weekly chart here, just to show you that the overhead resistance here is for this week just around 13. Next week it will be a bit lower, of course, but that's still a very important trend line that we need to break above, I think, to confirm the bottom around 6,000. And now the daily chart, I've done a Fibonacci retracement here from the all-time high, just below 20,000 to the recent low at 6,000. And the 50% retracement is 12,946. So around that 13,000 level again. The 38.2 retracement is 11,300. We're still quite far away from those levels. And the only downside here in this chart is that the 50-day moving average is moving below the 100-day. It's crossing below here. So that's not a good sign. So to conclude, yes, markets look very much all over the place. I know some people are confused right now that the bonds dropped yesterday, yields spiked higher. We're making new highs today, and the stock market keeps going up. I think we need to ignore these. I think the longer term trends are for a weaker dollar, higher gold price, higher yields, and I think the stock market is just making a correction right now. This is not, we're not going to resume the bull market, in my opinion, unless we get a complete reversal of monetary policy or Fed policy. Cryptocurrencies continue to do well, and we just need to keep an eye on them. And Bitcoin, of course, the key level there being around 13,000. See if we can break through those levels, and that we could see an acceleration higher. So if you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet. You can also follow me on steemit.com and on Twitter, and I'll talk to you later. Bye.